Good afternoon, everybody. I'm Mike Greenlay, and welcome to Tradition's Going Vertical podcast. It's my pleasure to again have Erik Hendrikson as my co-host, and our special guest today is Joe Bauer. He's a Chief Lending Officer with Tradition Capital Bank. And Joe, welcome aboard. And actually, I should say welcome aboard again because you've been a guest of ours previously, so it's great to have you back. And we want to always update whenever we do a podcast. We always want to update how the market is, but also how it is reflecting on the bank. But first of all, I want Erik to kind of go over his view as a mortgage guy, his view of what the market's doing, and then we'll kind of segue over to the bank side of things. And I know there's a lot of similarities, but it would be interesting to see how things compare and contrast in that way.
Yeah, thanks, Mike. I thought it'd be great to have Joe come back and talk to us. We talked to him kind of late spring, I guess it would be, and now that we're kind of getting towards the end of summer, just to talk about the new construction side of the housing market in particular. Tradition Capital Bank is really one of the premier banks in the Twin Cities that handles new construction. That's both from a consumer taking out a construction loan to build their home, as well as building companies using Tradition Capital Bank with major funding lines to build houses en masse. So these guys, and Joe in particular, are kind of right at the front and center of everything that's going on in housing. So just to kind of touch base with Joe and just get his take from the bank side as to what's going on. Certainly from the mortgage side, it's been really interesting this last couple months where, we came out of the gates this spring and it just was crazy, and the purchase agreements for new construction homes were just really coming in. But then with material costs spiking significantly and having issues with crews and labor for a lot of the subcontractor work, it really, in some cases, almost hit a hard stop here the last month or so, where builders were actually imposing some limits on the number of houses they would sell just because they didn't have a firm grasp on their costs. So they didn't want to write a bunch of purchase agreements on houses they were going to build for a loss. And also thinking that, potentially if they waited a little bit, supply would catch up and it'd just be a better customer experience. So it's really some interesting times, and just really curious to get Joe's take as what he's seeing as he's working with his builder clients.
Yeah, thanks, Erik, and thank you both for having me back. It's been quite an interesting market, I would say, the last for the summer months, certainly kind of those beginning spring months too. And our builders have seen things change a lot. I mean, it started out with kind of lumber prices being really high, and then it seemed like throughout the summer it was a little bit of just whack-a-mole with, if it wasn't lumber, then it was steel, and if it wasn't steel, then it was appliances, and if it wasn't appliances, then it was subcontractors that were tough to get or increasing prices. So kind of like what Erik said, I think with that much uncertainty in pricing, and a lot of that was dictated just with supply chain slowdowns and things, with plants being shut down from COVID, and then just lack of people being out in the workforce then too. That's really what kind of drove a lot of that. So that drove a lot of frustration for builders, because there was interested buyers out there, but it was an interesting time just because historically doing a spec was kind of more risky, and it was interesting to see where like a pre-sold actually turned out, because you were locking in the price with the consumer, to be maybe a little bit more risky than a spec was, just because the risk was if you built that house and you'd already locked in your price and all of a sudden prices kept going up, builders didn't want to do that as much. And so we were seeing them not be as interested in pre-solds, and like Erik said, maybe putting the brakes on a little bit just because they weren't sure what they could build the house for, and then moving into a little bit more of a, hey, we'll continue to build a little bit of houses just so we have a little bit of inventory out there, but we're going to do those on a little bit more of a speculative basis, knowing that there kind of was interested buyers out there, but they just didn't want to lock in the home with the buyer then on the front end. So that was a very kind of interesting thing to see and change in what we'd historically seen in the markets. I think that's normalizing a little bit more now, as the builders are kind of saying that, hey, even what we were seeing, in the late summer, prices have come down. They feel like those things are stabilizing a little bit more. They're more comfortable, kind of going to that pre-sale model with the consumers out there. But I think even the consumers were were starting to kind of be a little bit hesitant to move into that new construction, because that kind of was very prevalent in the news with lumber prices are at historical highs. So you saw consumers questioning, do I want to build right now or do I want to wait? And so I think that was causing a little bit of, like Erik was saying, some slowdown in the new construction activity in the summer. The good news is rates have stayed low, so those people who've actually come down a little bit. So those people who have waited haven't been hurt by a rising rate environment and have actually seen some benefit from those prices coming down. So the traction seems to be really good right now, and I think the builders are optimistic that the fall is going to be a good fall for them.
Yeah, and I think that the catch up with the supply, you haven't heard about plant shutdowns or other things. So I think the supply is coming, and with this almost, I didn't want to call it a pause. It's almost like an intermission. It's like a first period intermission in a hockey game, just to redo the ice and come back out and play some more. So I think, we do have a lot of clients on the mortgage side that certainly are interested in new construction, but they are taking a little bit of a more patient view of things. So again, as long as this Delta variant of the COVID virus doesn't manifest itself in such a way like it did early on in 2020, where you had production mills shutting down, hopefully it will continue to catch up. So this pause, although it's kind of a bummer when we're in the business and we make our living off of providing construction financing and home financing, hopefully this pause will allow things to normalize a little bit, and then when it cranks back up again here, hopefully Labor Day or right after that, it could be a nice stretch run for 2021. So it's going to be very interesting. I think the next 30 days will be really, really telling to see just kind of how the end stretch is going to be for new construction. So definitely keep an eye on that for sure.
I was going to say, and I think the positive of all that was the builders' pipelines were getting pretty full. Like actually that even just a little bit of pause, actually the blessing was like it allowed them to play a little bit of catch up on things then too. That backlog that was growing and growing because of the demand. Actually those backlogs have kind of normalized a little bit more. So which is good, because instead of telling a consumer, I'll start your house in 6 months, you know what I mean? They can get to it a little bit faster, and those houses can get built in a little bit more regularly scheduled time frame than what we were seeing kind of in those summer months then too.
It's quite clear that you guys are the businesses are connected. The markets affect both of you in similar ways, and that means that you guys also are connected in other ways, because there's partnerships there, and we often talk about Tradition's vertical integration, where one company works with the next one, then works with the next one, whether it's development, building, banking, mortgage, all those kind of things, and they're all intertwined. But you guys are connected a little bit tighter, obviously, because you're both in very similar fields. Can you kind of talk, first of all, Erik, a little bit about how that relationship works and how you guys can, have each other's back even when things get a little dicey, as they have in the past year and a half?
I appreciate that, Mike. I would say, like, amongst all of the Tradition companies, the 8 or 9 companies that we have out there, I would say that the relationship between Tradition Mortgage, my company, and Tradition Capital Bank, Joe's company, it's probably the most direct, and it's probably the most intertwined. Well, not probably, it is the most intertwined. We are very codependent on each other in a lot of ways, and some ways that are more customer facing that people would be aware of. One of the examples is the construction to perm loans, when somebody comes in and they want to construct a new custom house, and they need a construction loan to build it, and they want to have a long-term financing, a long-term mortgage at a competitive interest rate, once the house is complete. So that partnership between the mortgage company and the bank and the product that we put out there has been around for a long time. We've done a great job. We have made some exciting tweaks to that, and I'll talk about that in more detail a little bit further. But beyond the consumer-facing piece, behind the scenes, there's an incredible amount of intertwined roots. One of the things people don't realize, like the funding line. So Tradition Mortgage, which is one of the larger independent mortgage banks in the state, funding $100+ million in mortgages a month, the funding capital for that. We have a large line of credit. It's kind of referred to in the industry as a warehouse line. It's a temporary line. That capital is provided by Tradition Capital Bank. So they're our backside capital source, and that's a very niche technical business on the mortgage side. And Joe brings incredible expertise to that area as well. So that's been really important for us as we grew as a mortgage company to have that reliable source of capital and scalable too. So as you grow as a mortgage company, you still got to fund all those loans. Yep. So if you get too big for your warehouse line, even if you have demand and you don't have the capital to make the loans, you're going to be in trouble. So that is just a really incredible piece. And just the overall banking and just the interconnectedness. There's a lot of pieces accounting wise that go along with that, and the bank has done a fantastic job. But one area that I wanted to talk about that's relatively new that we've been doing this year, and it has grown out a little bit of an interesting situation in the banking markets, but it's created an opportunity for us. It's just a lot of banks in the country, and certainly in the Midwest, are in a really unique situation where they're sitting on a very high level of customer deposits. Now, just banking in its simplest terms is taking in people's deposits and lending them out, making loans and making a net interest margin, a spread on that. And that's just kind of how it works. But if you get out of balance, if you have too much loan demand for your deposits, you're short on deposits, then you got to go look to borrow money to turn around and borrow money. So that gets expensive as a bank. But and that's kind of been the challenge the last 15, 20 years is there's been so much loan demand out there, both commercial and consumer. Banks have had a hard time finding the funding sources for it, i.e. the deposits. So they're just, always hitting up customers. Hey, do you have more deposits? You can move over to our bank. Where can we what rock can we turn over to try to find customer deposits? Well, and just for a lot of different reasons, and Joe can probably name a few of them, in 2021, it's a complete opposite where banks are just swimming in deposits. This deposit liquidity is off the charts. And what they're faced with is they have to pay a certain level of interest to the depositors in many cases. So now they're like, we got to go out and find some loans to make. And that's one thing we've been blessed with here in the Tradition companies with Tradition Capital Bank and Tradition Mortgage. We have strong sources of loan demand with our construction lending and our consumer mortgage lending sources. So Joe and I, we had gotten together, talked about, okay, can we take, on the mortgage side, can we take some of these mortgages we're doing and put them in bundles and sell them in kind of a bulk package to some of these banks out there that are really, really, really starved for loans, and can, we drive a great price that we can pass along to our customers. So we kind of focused on the jumbo, the larger consumer loans, which is kind of a niche marketplace that we have, and take advantage of those relationships. So that's one thing that we've worked on. Tradition Mortgage is a point of sale. We have access to a lot of those customers. One thing, though, as a mortgage bank, we don't have is a servicing platform or capital that we can basically park for several months, and that's where the partnership with the bank comes in. They have that servicing platform. They can park these loans. So Tradition Mortgage will underwrite and book the loans, and then we'll transfer them over to the bank. The bank will purchase them, put them into a loan pool, service them, and then we basically put them out for bid and sell them as a bulk package. And it's just really a cool niche thing, but it's really allowed us as Tradition companies to offer our customers an incredibly competitive jumbo mortgage.
No, I think, Erik, you're totally right. It's just such a unique time in the banking market, and a lot of that has to do with some of the unique things that happened in the last year and a half with, the government put a couple $1 trillion in the system with the stimulus package, and a lot of that relates to, a lot of people are familiar with the PPP loans that were funded by banks for businesses that were used to hold on to their employees. Well, there was a lot of uncertainty at that time, but it was what the results of it really were that it injected a lot of liquidity into the banking system, because there was plenty of businesses that needed that liquidity to help with the help keep their employees. But over time, as the things normalized and the economy improved, a lot of what happened was those businesses that were able to do okay through COVID ended up paying down debt and sitting on deposits. So that injected a lot of those businesses are sitting on a lot of deposits at the bank, and in turn, like Erik said, that's the fuel the bank has to do loans. And especially for a high growth bank like Tradition, it's a unique spot to be in, where we have a lot of liquidity, and we actually have more deposits than we have loans. And there's a lot of banks throughout the country that are in a similar spot. And so banks are really looking for loan demand, and we're fortunate enough to have partners like Tradition, who, well, that's their business, is generating loans. So if we need loans, hey, I can look to Erik to say, what can we do here? We have some liquidity, because it's not a good model for the bank to have all this liquidity. And when rates are really low in the marketplace, the bank will look to put those in just overnight funds, and those are only paying really low, 10, 15 basis points. And when we're paying 25 on our savings accounts or more, that's not a good interest. That's a negative interest rate spread for us. So we want to put those out in loans that are 2.5%, 3%, 4%, that we can put the loans out there in higher yielding products that'll allow the bank to be more profitable. And so in conjunction with that, Erik and I, knowing this is a unique time, just said, okay, how can we deploy some of the bank's liquidity? And like Erik said, we've kind of come up with a program where Erik's mortgage company sells the loans to Tradition, who needs the loans, instead of one-off selling them on the secondary market, which is what most mortgage companies do. The bank has a large enough balance sheet to hold those loans for a period of time. And then we've kind of gone with, when we build those mortgages up to a point where we have 20 to 25 million or so built up and purchased from Erik's group, then we look at it and say, hey, there's other banks that are out there throughout the country that have a similar need for loan demand. And we say, hey, we have a pool of these jumbo mortgages, and the nice thing is they're really good quality deals and with really good borrowers, and there's a lot of banks who would like to have those mortgages on their books. And so we've kind of gone and said, hey, we'll sell these loans to you, and there's been a lot of demand for those. So it's been a nice model, and it allows the customers, like Erik said, to get a very good competitive price, because we're going out to all these banks throughout the country to bid these mortgages, and it allows us to know that, hey, we can offer really competitive rates in the Minnesota marketplace to these customers who want to finance their mortgages, whether these are construction loans that are moving to permanent financing or refinances or purchases, all of those things. But the quality of the borrowers are really strong, and they're competitive interest rates, and there's good, strong demand out there throughout the country for those. So it's been a very good product and very good program that we've been able to roll out then too.
Tradition Mortgage, as an independent mortgage bank, our typical the entity that's buying our loans is typically what we call these large investors or aggregators, your Chases, your Wells, your PennyMacs, just these mega players. That's their business, is to buy these loans, and they're turning them and they're securitizing them with Fannie Mae or Freddie Mac. They're doing private securitizations. It's you're selling them on a daily basis on what's known as a flow basis, or a mini bulk, where you maybe sell a pool of maybe 10 or 15 loans, and it's typically under 10 million that you're selling. So that's kind of the normal game that an independent mortgage banker kind of plays, and that's our normal business. But what the Tradition Capital Bank partnership allows us to do is kind of do a mega bulk sale, where you can build up a very large pool of loans, and you can sell them just as one kind of bulk package. And what you do in that case is you open up a marketplace to bank buyers that aren't your typical investor aggregator mortgage people that are playing the game every day. They're just maybe more of a regional bank that just needs to backfill. Again, they're lacking in overall loan demand, so they can just make a one-time purchase, and it's easy. So this actually opens up a whole new customer base for Tradition Mortgage to sell our loans. So just this partnership has just been tremendous, because again, we're able to take care of our customers and offer a competitive product, but also work with a whole new set of bank customers out there that like the quality of our loans and just want to make one purchase of a large batch, so to speak. So it's a unique. The mortgage banking world is not something that people talk about much. So this whole discussion may go over a few people's heads, but I think it's just the point is the partnership between the bank and the mortgage company does allow us to offer a very competitive product to our customers, and it does allow us to help serve some of the banks out there, in the country that are really hurting for loan demand.
And I guess I can just sum it up by using a really big industry term, and that is basically, I'll scratch your back, you scratch mine, right? Because that sounds a lot. It is. It is a good relationship. So let's kind of wrap this up with a little bit of I guess foreshadowing. Do you guys, where do you see things going? Part of your job obviously is to find solutions to unique situations, and obviously in the past year and a half you've had to do a lot of that. So where's the parameters for where you're looking forward to in the next 3, 6, 9 months range?
Yeah, so the mortgage market forecast really, the big question is, what are interest rates going to be doing? Because that really drives our business. That's 100% of our business is where interest rates are at, and quite frankly we were on the way up for the first part of 2021, and if it wasn't for this Delta variant of the COVID kind of emerging again and just putting into question the economic recovery, or at least kind of putting into question the strength of it, things are continuing to move forward. But so if these cases drop down sooner rather than later, that's going to put upward pressure on interest rates. We've been blessed that the Federal Reserve has been buying millions of dollars worth of mortgage-backed securities, to really subsidize the marketplace. And the idea behind that is just to really be supportive of economic growth and keep costs low for consumers. It's hard to justify that when the economy's back, at 100% strength and everything's, moving forward. So the Fed's catching some heat for continuing to buy mortgage bonds and treasuries. This Delta variant has probably given them a little bit of cover, but once that starts to taper, you hear the word taper talk and taper tantrum, things will get interesting. And I think by and large we bought ourselves a couple more months, but as we get towards the end of 2021, things are going to get pretty interesting. I by no means see the rates just spiking, but I do see them going up. You could be 50 basis points for all we know, which would be pretty significant move. That's the bad news. Good news is that still means like mid threes, which is crazy low historically speaking. So if you keep it in a greater context, so I think you'd see a little bit of heartburn. Certainly the refinance market would be pretty much muted out pretty good. I think just from a standpoint of getting a lower rate on your mortgage, refinancing to do home improvements or other things, that's always there too. So, life goes on. The mortgage market survives. I think the housing market, you're going to see a lot more supply come on over time, and even in the mid threes, I think people are still going to be very excited to buy a house. So, I mean, it's, everyone's going to be earning their money in the mortgage business, though, in 2022. That's my prediction. From a banking perspective, give us your take.
Yeah, I agree with everything Erik said on the interest rate side of things. I think, I'll kind of just focus on that construction market. I think from what we're hearing from the builders is that I think they think it's going to activity in the construction space is going to be strong. I think that it's going to continue to be what's happening in the marketplace right now is rents continue to go up. And it's still hard. It's still, even if supply kind of increases a little bit, we're still at a historically low level of supply of homes. So it is still, if you're interested in buying it, it's hard to find an existing home. Mm-hmm. And if rents are going up, the builders feel like there'll continue to be good demand for new construction in the marketplace from their side. And then I think from the consumer standpoint is as we're seeing prices normalize, we're seeing supply chain kind of get back to a little bit closer to historical norms. I think that attraction to build the house, even though like Erik and I talked about, might have been on pause or slowed down just for a little bit. I think that's going to continue to increase here as we see over the next, especially, we typically do see a little bit of a slowdown in demand in the summer just because people are doing things and, but as you get into the fall and you want to get that house built before school next year, I think we're going to see that pick up a little bit more. So the builders feel really good about it, and I think the consumers are going to find that the construction is a good option for them as supply stays low in the housing market.
Well, gentlemen, some very interesting information, and I said it's always great to see partnerships develop interesting solutions to unique problems, because I guess that's what you do, right? And that's what you're supposed to do. So, Joe, thank you again for joining us, for a repeat performance, because it's always good to have your perspective as well as that of the banking and banking market. And Erik, thanks for joining me once again, and we'll keep them rolling. We'll keep bringing some interesting guests towards you.